Howdy, Jacob here. Today we're looking at ticker symbol OKE. Let's look at the business. So $41.7 billion market cap, $62.9 billion enterprise value, good amount of net debt there. Currently a 5.4 roughly percent dividend yield. Business itself, 11.8 billion in 2013 to 22.3 billion. Looks like a lot, but then I'm assuming there must have been some sort of acquisition or something recently to make revenue in 2 years go from 8.5 billion to 22.4 billion. Pretty low return on invested capital, average pretty low, probably 5% about. Let's look at that balance sheet. So 12.7 billion long-term debt, 6.5 billion 10 years ago, so roughly double, a little less than double. Cash on hand, only 220 million, so way less cash on hand than debt. Let's look at their free cash flow. Okay, so free cash flow, 2019 negative, 2020 negative, 2018 46 million, and then the most recent 2 years, roughly 1.9 billion and 1.7 billion. Okay, and they're paying out 1.7 billion. Okay, so payout is pretty huge. It looks like there actually wasn't any acquisitions, so their revenue jumped up. There's no way that's all from inflation. That's so much. Transportation. Okay, that could be it, I guess. It seems interesting that it almost tripled in 2 years. I don't know how reliable that makes me feel. But anyways, I think we can get to some assumptions here. For dividends, I mean, a 5-year average, 3 of the 5 are 0 or negative. And so I don't know how I do know they're producing a dividend through a little bit of issuance of shares and then a lot of issuing of debt. And so for like a true business, they just can't afford that. Let's say drop it by 4, payout of about 400 million. I mean, I feel like they could afford that on the cyclical basis that their business seems to have. Some years is 0, some years negative, other years almost $2 billion. So I feel like they can afford a roughly $400 million payout. But that would, bring their yield down to maybe 1.3% or so. So definitely doesn't even hit our 4% criteria that we want in the screener. But we'll continue with assumptions to see where it lays out. Again, they've grown so much recently. I just feel like I just don't see how great the growth could be. But we'll do 3%, 13 on the PE, price to free cash flow, saying that after 7 years, maybe there'll be a little bit more growth, or a little bit more growth than nothing, but not a whole lot ahead of them. And then for margins, let's look at the averages, 8 and 4. I don't like that the earnings have been higher, but at least the last 2 years, if they can be consistent with that, they're looking pretty good. Where their free cash flow is as high, if not higher, than the earnings. So maybe 7, 6, 8, 6, maybe 3%. Yeah, it's looking ugly. So it's saying that the company's stock price would have to fall 78% to get us to a 15% yield, given these assumptions. I mean, right now, I just don't think they can afford that dividend given the cyclicality of the business and the little cash they have on hand. Because their cash on hand was $220 million and they pay out $1.7 billion. And so if they had a negative year, they're just going to have to issue debt or issue shares, and we don't want them to continuously have to do that to fund something. We want it to be funded by the business, and the debt is for growth, or if shares are really cheap, to be able to buy back shares, that type of thing. You don't want to fake a dividend that you can't afford just to uh, consume investors' ideals. But for me right now, yeah, definitely just waiting. Not super eager, not super crazy excited to take a look at it. But I think it's a fine company. I don't think it's anything crazy for this dividend yield screener, because again, we want one long history of dividends, and then two, a smaller payout ratio. And right now, it's over 100%. So keep that in mind when you look at companies, or if you want to look at this one. But for now, I'm just waiting. So thank you, and have a good day.